Good morning and welcome everyone to the Moneycontrol live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. Well, Indian equity markets are likely to set for a soft note start, tracking mixed global cues. Gift Nifty signals an exit start coming in for the Wall Street. US stocks mixed, almost ended mixed after job report fails to calm the rate hike fears. Well, the June jobs report was weaker than expected with more jobs being added, but the growth in average hourly earnings was unchanged at 0.4%. Asian markets trade mix as investor balanced risk. Talk about FIIs, they've bought shares to an extent of around 790 crore and DIIs have sold shares worth around 2,964 odd crore. So FNOQs, we have almost 26 stocks which have seen long build-ups, and these includes the like of Indiabulls Housing Finance, Granules India, Cholamandalam, Bosch and Tata Motors. Well, some of them which have also seen in the long unwinding, 77 of them almost there. BHEL, ACC, HDFC Lupin and Intellect Design Arena are some among them in that list. Short build-up, 75 of them, which includes the like of India Cements, HCL Technologies, Aurobindo Pharma, Aarti Industries and Eicher Motors. Let's also talk about short covering. 12 stocks have seen short covering, and these includes the like of Titan Company, Petronet LNG, Ashok Leyland and REC amongst others. Also, let us get going and discuss some stocks and strategies now with Prashant Shah, the co-founder at Catalyst Wealth. Good morning there. I'm going to start off by asking you about the PCR and the trade setup that looks. Do you think market still remains in that overbought territory, looking at the technicals level? We saw a bit of consolidation finally creeping into the markets on Friday after that 7-8 consecutive session of uptrend. Do you expect more consolidation to creep into the markets or remain in the markets in this week also?
A very good morning, Nickey, and good morning to all the viewers. So I think the price action on Friday was a little dampening to all the bulls. And I think we made a new high, but where we closed was a little bit of a concern. So now the scenario would be that the support on Nifty futures, that is July side, a major zone which should not be broken, would be somewhere approximately between 19,160 and 19,210. That from a positional perspective for the trend to remain in the same strong zone would be the same. Otherwise, it might go in a consolidation zone. One strict recommendation would be do not short both the indices. I'm still seeing a bit of steam left in both, especially Bank Nifty. Now, talking from a Nifty perspective, the resistances would be in July futures somewhere around 19,500, which is 19,485 to 525. So approximately 19,500. And what matters now is we need to close above Friday's high for at least a day more, because that would once again be a convincing statement by the bulls that we are back in the game, and we might look at levels which will be near to 20,000. But for now, on the downside, 19,200 needs to hold. As against this, when I look at Bank Nifty, I'm looking at that more as a dip. And 44,800 on the futures happens to be a major support, which needs to hold on a closing basis. If that is broken, we may nosedive to somewhere around 44,400. So for me, 44,800 is a make or break level in futures. On the upside, 45,250, 300 zone is a big resistance. If we cross that, I think we may straight rally to 46,000. So overall, if I compare both the indices, I think Bank Nifty looks in a better shape.
That's a bullish call coming in for Bank Nifty, Mr. Sawan. I'm going to also check with you your strategy on RIL and something like an HDFC Bank, because RIL is expected to dominate the conversation in today's trading session at least. How are you viewing the charts right now?
So I think as far as HDFC Bank is concerned, it has seen a very good rally. And from there was a bit of a correction, which was expected. It's a dip. But if you look at RIL, I think the pre-open today shows a straight 55-60 point gap, which in fact is giving support to Nifty. So if we manage to sustain that level, and if we manage to close it in spot somewhere around 2,700, I think that would definitely give a strong rally to the stock, thereby giving a rally to Nifty as well. So for me in RIL, 2,700 spot is a make or break level for a fresh leg of rally. And if we close above that, I think the doors for 2,800 would definitely open.
All right, that's the word coming in for Reliance, probably the stock that you need to keep on your list today morning. But I'm going to be dwelling more on Reliance Industries. Stocks news to be addressed now. Reliance Retail Board has approved a reduction of equity share capital, and the reduction will be to the extent held by the shareholders other than the promoters. consideration of to an extent of 1,362 rupees per share based on valuation, and these valuations have been obtained from 2 independent registered valuers. Also, the company has fixed in July 20 as the record date for the shareholders to receive Reliance Strategic Investment shares. Reliance Strategic to allot 1 share for every 1 share of Reliance. So 1:1 is technically what the ratio is. Reliance Strategic Investment will then be renamed as Jio Financial Services. So a bit of development there, demerger there, listing there. So that's the word coming in overall on RIL. UBS technically suggests they've maintained the buy rating level and have recommended a target price of around 3,000 and values RRVL at $110 billion. And RIL's 85% stake in it to an extent of $93 billion, and thinks that this sets the floor price to future value unlocking, which should bring confidence to Reliance business, that Reliance retail business value for the SOTP consideration of around 1,362 rupees. That price, that consideration is almost at 54 to 60% premium compared to the valuations that have been obtained from the valuers. That's the word coming in for RIL, an important development out there. We're going to be addressing in more, and we're going to be bringing in a special guest for you. But first, market open. Nifty 50, we are looking at a positive start coming in for Nifty 50. Gains to an extent of 0.2% out there, 19,375. Well, 19,000 below that level of 19,400. Let's look at Bank Nifty just to see how that index moving. And if there is some amount of outperformance coming in, well, it's a bit of a soft start, I must say, but with positive bias. But Nifty has held on to gains, I must say, after a session of consolidation. Mixed global cues, given what the globe has done in equity markets, relatively is fare better. Mid-cap index, that's another one that you need to keep on your list. It's outperforming. Small-cap index too, pretty much as the trend goes. More of a 0.25% of gains coming in for mid-cap index. If you look at the other sectoral indices that we have overall, IT index is not doing well. Earnings season pretty much kickstart this week, and you have IT index right now, which is actually surrendered into selling pressure at the start of the week. FMCG basket has been holding well and has been an outperformer through and through for the entire year, and this session is no different. Let's talk about other sectoral indices that we have on the chart. Pharma index has been doing well, and also something like more of the sectoral indices that we have on the list. Consumption story remains intact. Let's bring in top gainers and top losers that we have just to see how the trend has been shaping up for the markets overall. Auto index has been doing well also in trade. But top gainers, we did talk about Reliance, and there it's at the top of the list, and hence those gains coming in for Indian equity markets despite mixed global cues. Tata Motors, Bajaj Auto. So auto essentially is contributing to the rally. Hero MotoCorp, something like an Ultratech Cement and Asian Paints also is doing well in trade today. Maruti Suzuki and Tata Steel, you just can pick the entire auto basket and probably put it out there. It's just the top gainers out there on the list. And if you talk about the top losers, that's where, also IT counters are taking hit. HCL Technologies, TVS Lab, TCS, and Bajaj Finance are some of the names out there. But another stocks and news that we have, HDFC Bank needs to be on your list. The bank is going to be selling in 2% equity stake in NSDL IPO via an open offer. The bank currently holds 8.9% stake in NSDL. It has offloaded 1% stake in December 2022 for rupees 110 crore at a price consideration of rupees 2,750 per share. MSCI, that's added in HDFC Bank to Global Standard Index edition after the merger of HDFC with HDFC Bank, and has removed, of course, HDFC from Global Standard Indices list. The change is going to be effective from July 13th. Cyient DLM, keep an eye out on this one. It's going to be listing in today, and expect a strong listing. Final strong issue, the issue price was set at around 265 per share. Grey market premium was to an extent of around 52 to 57 odd percent. And do remember the fact that this 590 crore IPO was subscribed 67 times. And, we've also seen that gains coming in for Idea Forge, right? And just not as the demand wasn't strong as much for this IPO, but surely there is a subscription here. If you compare the numbers, it's received with overwhelming response, and we are looking. Probably the street is expecting at a fairly decent start coming in for that one. But Prashant, quickly come in on this one. We are looking at auto names which are doing well. What do you like within the auto basket? Is it a Tata Motors or an M&M? How are you looking at it?
So, Nickey, I definitely like Tata Motors. It surely goes at the top of the list. But we need to focus on the tire stocks as well. So, I think Apollo Tires definitely is trying to make a statement, and it's currently at 420. I think if we manage to close above 425, it might straight open up the doors for somewhere around 445, 450. So tire stocks, I think, are on my radar. And along with that, one more stock which I think might pick up very well is Ashok Leyland. It's currently quoting around 164. I think one might go in positionally with a stop loss at 155 and look for targets around 180, 185. I think that is due for a big set of rally. So I'm looking at this one closely.
All right, that's the word coming in from Prashant Sawant. Prashant, thank you so much for taking out the time and speaking to us this morning. It was indeed a pleasure chatting with you as always. All right, we're going to be navigating our discussion now around the Q1 season. It's going to be kickstarting this week with the IT numbers, and there are too many changes which are expected to take place, how the markets would fare. To take the discussion forward, we're being joined by Gautam Duggad, the Head of Research, Director Institutional Equities at Motilal Oswal Financial Services, who's joining us straight from the studio. Good morning and pleasure to have you with us this morning.
Good morning, Nickey.
All right, so I see a very long strategic report, Q1 report, which is mix of blend of model changes in the portfolio and your expectation, Motilal Oswal Financial Services expectation from the Q1 season. I'm going to get on to that. But first, I'm going to ask you on a very aerial level, on a very aerial view, that we've seen that rebound coming in for the Indian equity markets, but despite that, we're still underperforming most of the global markets. How would you read into it? How are you finding the valuations at this point of time? Your assessment on that.
Hi, good morning. Thanks for having me here, Nickey. See, when you look at the markets, last 3 months, you've seen some rally from the bottom of March.
Right.
So your mid cap and small cap index is up 20%, and I think Nifty index is up around 10 to 12%. Year to date, Nifty is up 7%, and it's underperforming most of the global markets. You know, S&P, Nasdaq,
right.
Some of the other developed markets like Japan and some markets in Europe. Much is being made out of this rally, and people are questioning if this is a euphoric or all. My point is, if you look at a 5-6 years basis, the small cap index has given an abysmal 7% compounding. Mid cap index modest 11 to 12%, and Nifty also somewhere in the similar range. So that is point number one. On valuations, Nifty is still trading in line with its averages. Mid cap index at an index level is at a marginal premium of 10-15%, and small cap index is still at a discount. So I, for one, clearly do not think this is euphoric. Second, we've had a 18-month long consolidation or a time correction in Nifty.
Right.
So the 18,000 of October 21, or rather 18,500 of October 21, and current 19,000, 19,500 are very different. When Nifty hit 18,400 in October 21, the valuations were 21.5 times 1 year forward. Today, when you are at 19,000, 19,500 range, the valuations are at 18.5 to 19.5 times. And in another 3 months' time, we will start looking at FY25.
Right.
Moment you start looking at FY25 in another 3-4 months, valuations will become even more reasonable at about 17.5 to 18 times. So while the levels have gone up, and there are a lot of media headlines every single day, markets at a new high, new high, new high. But the point is, valuations are still very reasonable. Second, earnings are also at a new high. Right? 3 years back in FY20, NSE 500 corporate earnings were 4.5 lakh crores.
Okay.
FY23, the same earnings were 11.1 lakh crores. So from 4.5 trillion to 11.1 trillion, earnings are also at a new high.
Right.
GDP is also at a new high.
Right.
So today India is in a very unique scenario where both macros and micros are firing well together.
Right.
GDP of 7.2%, one of the highest, I think, last year in FY23. Inflation is coming off. Rate hikes are behind us. External balance is comfortable because crude is range bound, and you've seen current account deficit, fiscal deficit, all of them are in a range. Plus currency has been very stable.
Right.
So macro is looking quite healthy right now.
Right.
And on top of that, earnings have been quite resilient too.
Right.
Fourth quarter, we have seen about 15-16% earnings growth. This quarter again, we are seeing about 12 to 13% earnings growth for Nifty X of OMCs. on a reported basis, we are talking about a 25% earnings growth for this quarter for Nifty. Our full year assumption is somewhere about 20% for Nifty. X of commodities, again, it is 16%. So if earnings are good, macro as of now looks quite solid, and valuations are also quite reasonable in my view. They are well in line with long period averages right now. We are not trading at a 20-30% premium. You start calling it euphoria when at an index level the P's have crossed 23, 24, 25. We are far away from that place. So yes, there is pockets of exuberance in some of the mid and small caps, but that cannot be used to justify and paint the entire market as euphoric. We are at a new high, but so are earnings, so is GDP, and the rest of the parameters like we spoke about are looking quite good. In fact, you look at the FII flows.
Right.
Between October 21 to February 23, there's been a massive outflow, about $17-18 billion. Last 3 months, the flows have turned. And we have seen about $12-13 billion of inflows already from April, May, June, and till YTD, I think, month till date July. Domestic flows in the same period when FI flows were out, were an outflow of $17 billion, the domestic flows were an inflow of $51 billion. So look at the scale of domestic inflows. On the one side, you have FI outflows of $17 billion, and on the other hand, you have an inflow of $51 billion, 3x of that. Right. Secondly, when you compare India, because we do not exist in a vacuum, when you compare India with the rest of the world emerging markets, very few markets are offering you this kind of a macro and a micro combo. Growth in rest of the world is very abysmal right now. They are going through their own problems on slowdown. Inflation is turning out to be very sticky in the global markets. China has been disappointing as far as economic rebound is concerned. So by, when you look at the relative choices, India offers itself as a very unique combo right now. So I would think there will come phases where markets will take a pullback. There will be 5-6% correction. But looking at the earnings, looking at the macros, and overall global picture, I think we are in a fairly strong situation.
2 points that come to my mind. So you're saying the sentiment is upbeat but not euphoric. That's what your report says.
Yes.
And by virtue of that, you feel there is more steam to the rally. But before that, you expect some amount of correction to creep into the markets before we scale into probably more higher levels than what you are. Because Indian equity markets, I hope you agree, there is a level of underperformance technically, which is coming into the market, in the emerging markets basket, because of which we've become the beneficiaries to the FII flows. And that probably explains the amount of inflows that we've seen for the last 4-5 consecutive months. How do you view that?
No, so I won't hazard a guess on whether the markets will take a pullback or not. This kind of things are very difficult to predict.
Right.
We didn't say in March that markets will go off 12-15% and mid cap and small cap index will be up 20% in 3 months.
Right.
So it will be foolhardy to, sort of predict what is going to happen in the next 1 week, 1 month or 2 months. We will take as it comes. But what I am saying is it's quite natural for markets to pull back, right? When it has had a extended period of up move.
Right.
Without any pause or without any breather. That can happen anytime. And reasons can come from anywhere. It can be global, it can be local. Maybe some companies disappoint in the earnings season.
Which are those companies you think?
No, I'm just, talking about few possible scenarios where the markets can take a pullback.
Right.
Inflation may disappoint, some global central banker will make some comment which will unnerve the market.
Right.
So those 4-5% kind of corrections can happen any point of time. But if you're looking at next 1 to 3 years, then the picture looks quite bright, because earnings which have started their up move after 10 years of earnings recession. Look at it, FY10 to FY20, the earnings compounding was just about 6.5%.
Right.
Nifty gave you 8.5% compounding in that 10-year period.
Right.
Earnings started turning around after FY20. So FY20 to FY23, if you look at the total profit pool just of Nifty, I spoke about NSE 500. Now let us look at Nifty 50. Nifty 50 did a profit of 3.5 lakh crores in FY20. It ended at 6.35 lakh crores in FY23,
right,
which is about 80 to 83% kind of a growth and a 23% compounding. Right. In fact, the profits that Nifty companies did in FY20, about 3.5 lakh crores, in FY25, our estimate is only the financials, the cohort of financials, there are 11 financial companies in Nifty, they alone will do 3 lakh crores of profit in FY25. So 23% earnings compounding in last 3 years. Markets by and large has kept pace with the underlying earnings. So if next 2 years we are talking about a 15 to 17% kind of an earnings CAGR, I see no reasons why market cannot keep pace with that kind of a underlying earnings movement. Now, if for whatever reason there is a disappointment on earnings, there are downgrades, something somewhere happens, we are going into a big political event next year.
Right.
If that doesn't turn up as the markets are expecting, there are many possibilities which can happen. But at the moment, it looks like markets are in a fairly bright spot, and barring few episodes of some pullbacks here or there, I think the journey and the direction of the market is upwards.
Sure. Let's navigate our conversation more towards the Q1 earnings season, because in this week itself, we are going to look at a slew of numbers, probably from the IT basket creeping in. With your regards to your report, the three themes that you think would probably dominate investor community conversation would include politics, rates, and global growth. With that in the background, what do you think, barring banking and auto sector, which have been leading thus far, and there's been outperformance which is coming from in the FMCG basket, which pockets do you think would surprise the investors and probably lead to a sharp up move?
So if you look at the numbers, and since you are talking about a quarterly earnings, for the quarter, there are three sectors which are driving the growth. One, as you mentioned, financials. We are talking about a 32% earnings growth in private bank, almost 100% profit growth in PSU banks, 30% in NBFCs. And then autos, there is a statistical element there because the base quarter hardly had any profits. So on a YOY basis, the profits are up 11 times. But if you keep aside the losses of Tata Motors in the base, then we are talking about a 60% growth in profits for auto universe also. And most importantly, consumption is making a comeback. Consumption in that sector, we are talking about a 20% profit growth for our coverage universe with a 9 to 10% top line growth. So what is happening is margins are expanding. Commodity costs have come off. The base quarter had seen a commodity inflation, and therefore the gross and EBITDA margins had taken a hit. Now that is getting recouped. Right. So consumption, we had increased our weight in the model portfolio in April. In January, we had a 14% weight. In April, we had a 16% weight. And now we have made it an even bigger overweight with about 19% weight. So we have added another 300 bps to consumption, both staples as well as discretionary. This is one pocket where we are quite bullish, and we've been bullish for a long time. In between, there has been a breather of a year and a two when the market got fascinated by the value cyclicals, that kind of a trade for 2021 and 2022. We are seeing growth making a comeback as a theme again because rates have peaked and the underlying growth is improving. If you look about 2021, 2022, market gave a huge surprise in terms of some of the sectors which rallied 5x, 6x from their bottoms, something like a metal. You saw a huge rally in metal. Tata Steel at its bottom in 2020 was 250 rupees stock.
Right.
At its peak, it became a 1500 rupees stock.
Right.
And there are many such examples, JSPL from 70 to 500 and all of that. So that theme dominated till about first half of 2022.
Right.
The moment global economy started slowing, interest rates started going up.
Right.
You saw some of the cyclicals correcting sharply.
Right.
Right. So metal stock corrected 30-40%. Some of the other commodity stocks also corrected.
Right.
And towards the latter part of the second half of 2022, you started seeing some evidence of growth as a theme again making a comeback.
Right.
So in 2023 already you've seen NBFC is doing really well. Consumption as a sector is doing exceedingly well. Auto is the best performing index of CY23 YTD, up about 20%. Real estate has done very well.
Yeah. So rate sensitives,
rate sensitives, domestic cyclicals essentially.
Yes.
And they are the ones which are leading the earnings higher.
Right.
So I think this theme can continue for a few more quarters.
Okay.
Because look at it this way, auto has had a terrible 5 years of a downturn.
Sure.
The profits of FY18 and FY23 are same.
Right.
Auto as a universe in Nifty made a profit of 31,000 crores in FY18. They made 29,000 crores profit in FY23. By the way, in this same 5-year period, the profits of financials went up from 45,000 crores to 210,000 crores. So 5x.
Right.
And the other sector was stagnant.
Right.
Now we are saying that auto profits can double in the next 2 to 3 years.
Right.
And which is why we raised the sector to overweight in January, because after 16 quarters of a consecutive downgrades, we had seen first quarter of an upgrade happening in third quarter FY23. Then fourth quarter also saw similar upgrades in auto. And even in preview, we have increased our estimates for auto by about 4 to 5%.
Okay.
So we are expecting auto to continue to do well, and we've increased weight in auto also.
Okay.
And the other sector we have increased weight is financials, but not in the traditional private banks. We've increased weight in public sector bank and NBFCs.
Bank of Baroda to be specific.
So we had added Bank of Baroda a year back in April at a price of 86 in our model portfolio,
right,
with a 2% weight. Now at a price of 200, we are making it 3% weight.
Okay.
Similarly, in NBFCs, we were very positive when RBI paused the rate hike, and we thought this is now an opportune time to get into NBFC, because NBFC, unlike banks, is a trade. It's more of a tactical sort of a sector. So we increased the weight in NBFC in April. We added Mahindra Financial at a price of 235. And now at a price of 330, we are again raising the weight of Mahindra Financials from 2 to 3%. So I think while everyone owns the private banks, the real action can happen in PSU and NBFCs. PSUs, we've been a big overweight for more than a year and a half now. Mm-hmm. We have an allocation of 7% in PSU now versus our benchmark BSE 100, which is having a weight of 2.6%. And that conviction in PSU banks continues. In fact, a couple of days back, we came out with a very detailed thematic report on vehicle finance,
okay,
where our analyst team has basically articulated that they're expecting all the three stocks belonging to vehicle finance that we covered, Chola, Shriram, and Mahindra Financial, they've raised their estimates, okay, they've raised their target prices. Okay. They're expecting disbursement and AUM growth to continue at a solid clip of 20-25%. Right. So those are three big cohorts. We spoke about consumption, where we have gone further. We've added DMart now. We've added Zomato also in the model portfolio.
Right.
We've replaced Britannia with DMart and Jubilant with Zomato.
Okay.
We already have a huge allocation to IDC for last year and a half now,
okay,
which is done exceedingly well again. Titan continues to remain our preferred number one discretionary consumption pick, which is part of the model portfolio for more than 7-8 years. Godrej is there. We have a huge allocation towards hotels, okay, both Indian Hotel and Lemon Tree in our model portfolio. We continue to hold Metro, and now we have added Kajaria Ceramics. So there are about 9 consumption stocks that we have in the portfolio with a total allocation of 19%. So that basically tells you our conviction on this space, where we are expecting things to turn better as we move forward. Already they are looking better on margins. I think demand will also improve, because now we have seen in the last 2 to 3 weeks, the rent deficit has gone into surplus.
Right.
Till about third week of June, there was a deficit of 25-30%. Sure. Now we are talking about a 5% surplus. So I am expecting the management commentaries on consumption to also turn better.
Right. So just given by the preference of what your thematic report is, you have a higher weightage coming in for consumption, and post that, within that list would be PSU and NBFCs. That's how the ranking works for you, right?
Yes. So, okay, yeah, I mean, private banks we also...
One thing that surprises me, Gautam, here is the fact, I saw you added, you also introduced Avenue Supermarts, DMart in your portfolio. You spoke about Bank of Baroda, you spoke about Kajaria Cements, but I wanted to essentially place the focus on the new age company, which is Zomato, right? Zomato, along with, you have more of the, within that space, you have something like a PB Fintech, you have more of the names within the new basket, new age companies. What do you like within that, barring Zomato? And what's your reason for picking up Zomato here?
So, Nickey, we were very conscious when these new age companies were listing in 2021. We didn't start covering them because we thought things were way too euphoric and valuations were out of the whack. Everyone, was projecting numbers till 2030, 2035, 2040 also. So we stayed away. Even in 2022, we did not cover it. We started coverage of new age stocks only in April 23. So we launched our report on Zomato on, I think, 15th or 16th of April at a price of 54. And then on 20th of April, we started covering Paytm. Exactly. At a price of 650.
Yeah.
Right? These are the only 2 new age stocks that we are covering currently. So I have views only on those 2.
Right.
I think every successive quarter now from here on, you will see numbers getting slightly better for Zomato.
Okay.
Already the market share they're gaining.
Okay.
I think profitability, whether at a EBITDA level or adjusted EBITDA level, every sequential quarter you will see an improvement. Obviously, they are not going to report PAT level profitability already in this or next quarter, but I think that horizon is nearby now.
Okay.
And which is why we thought it makes sense to start covering those stocks now because valuations have beaten down. Euphoria has died down. The euphoria that you saw, existing when Zomato was at 140 or 150 is no longer there when it was at 54, 55. So we started covering there because we thought there is a reasonable margin of safety now. Already the stock has run up about 35-40% in line with the rest of the market and some of the other new age stocks. Yeah. But we still feel comfortable adding it at a price of about 74, 75 in the model portfolio, which is why we added it. Okay,
so as compared to a Paytm, you have added Zomato in your profile, in your model portfolio. So you are finding the business models of, sure, the fundamentals and the underlying business of these two companies are completely different, but you would pick a Zomato over a Paytm for that
So Nickey, I already have a lot of allocations to financials. Right. We have in insurance, we have NBFC, we have PSU banks, we have private banks. And the near-term upside, the kind of upside we have seen in Paytm also from 650 to 900, the relative preference between the two, we've chosen Zomato. Though we have a buy rating on Paytm also. And in fact, on Paytm also last week, our analyst team upgraded their numbers. They've raised their estimates and also raised their target prices.
Okay. I also wanted to chat with you since the cycle now is changing around and you will see much of the rate easing probably theme. We probably will say interest rates easing a little lower. With that in the background, I would want to understand which are the themes and the earning recovery themes. Sure, you've spoken about auto, you've spoken about anything over and above the usual suspects. If you could highlight those for the viewers. And also, you've spoken about metal being the laggard and continuing to act so, given how the uncertainty is panning out in globe and specifically with China, right? The slowing trend that we're seeing in China. How are you looking at the counter right now? Do you think at this point of time for metal, if someone is supposed to look from a very long-term perspective, it offers you a good entry point, or you're better off just not handling or entering into something like a metal stocks right now, which remain very volatile?
So for sectors like metals, there is no long-term because here things change every 3-6 months depending on what is happening globally because they're really deep cyclicals as such. What I would rather think is, as we move forward and enter into 2024 and conversations around monetary easing or at least a pause in the global central banks, playbook that starts happening, then some of these beaten down sectors which are cyclical, which were hurt because the growth came off and rates went up. So if one part of that equation starts turning in their favor, which is basically rate hikes get, there is a cap on rates and if you're lucky, there is a rate cut also at some point of time in 2024. I think that is when some of these sectors will start, firing again. On EBITDA per ton, on some of the other fundamental operational matrices, I think the sector is already bottoming out. I would think that this quarter, that is the first quarter FY24, metals EBITDA would have bottomed out. As per our numbers, because we split the full year into 4 quarters right at the beginning of the year, our numbers are suggesting that from this quarter onwards, the trend is picking up for metal stocks.
Okay.
But this being a very global sector and also dependent on what happens in China,
right,
the price movement can remain delinked from the underlying fundamentals for a fairly long period of time. Because the view on global growth, the view on global rates will right now matter far more than what is happening to a specific company's P&L in this kind of scenario.
Let's talk about IT because that's where the earnings season will kickstart. Are you still a little bleak on the sector given the kind of uncertainties that you're witnessing overall? And if yes, within that basket, what do you like?
So we are not negative on IT. We have a neutral stance and that is also very tactical. We've run a huge overweight on IT in 2020 and 2021.
Okay.
We were carrying almost 400 bits of an overweight then. It worked very well for us. But then in 2022, we were late in cutting our weights on IT, so it hurt us.
Right.
We've had almost zero allocation to mid-cap IT for more than a year. Now we have added a mid-cap IT stock, Cyient. Right. We have TCS, Infosys and SCL Tech in our model portfolio where we have done some sort of a reallocation and took out 200 basis point and added 100 basis in Cyient. My view on IT is that this quarter is going to be muted, which everyone knows. Right. So the direction of the stock prices will be a function of what the management commentary suggests for demand, the discretionary demand more specifically, and new order books, new order wins. which might come in the second and third quarter of FY24. That is what is going to decide the trajectory of the stocks, because right now everyone knows that 1Q is going to be bad, right? Which is there in the numbers, at least sequential dollar revenue growth if you see. The YOY profit growth will still look very healthy because of the very low base of margins that you're sitting on. In fact, we are talking about a 16% profit growth for our IT coverage universe.
Right.
I would be more sanguine on IT stocks now than I was, say, 3 or 6 months back, because these are all high cash flow generating companies,
and
which pays out
factored in.
80-90% of free cash flow you get back.
Right.
I remember between FY15 to FY22, the top 5 IT companies put together made a profit of 5 lakh crores, and they paid back 76% of that in dividends and buybacks. Right. So out of 5, you saw almost 3.8 lakh crores going back to the shareholders at dividend and cash buybacks. So there is a limit to which their price to earning multiples will fall, because you're still talking about a 10-12% kind of a growth for IT companies, because there is currency tailwind which comes in favor for them. Then supply issues have moderated, attrition has come off. The only missing element right now in the entire puzzle is the demand visibility, because most of the commentaries which are coming in, even from Accenture and other companies, is that the project pipeline has shifted in favor of cost optimization and vendor consolidation deals, and not the high margin value accretive digital transformation deals. Right. But at this price, I won't be negative on IT companies.
All right, and Cyient is your pick within the space,
mid-cap, within the mid-cap. Otherwise,
space.
Our top idea is HCL Tech and Infosys.
HCL Tech and Infosys. Okay, let's talk about primary markets. Flurry of IPOs, and this week also you have a couple of them. You have a couple of listing. We saw the IPO of Ideoforge. We saw Senco Gold, and also you have a finance bank which is going to be coming up in a day or two with an IPO. Within this space, what do you like? And also Cyient DLM IPO will be listing in, right? So how are you looking at those particular companies?
So there is one IPO which also came, which is IQ, which has done well. Then you've spoken about the drone company. See, the problem, Nickey, with IPO is in good companies, you don't get allocations, right? So they are getting oversubscribed 70 times, 100 times. So it's better to wait it out, see their performance for a quarter or two. Once the IPO market euphoria, it's not euphoric even in IPO market actually. If you look at the primary market issuances, they're just about making a comeback. And all the IPOs which have come so far in the last 1 and 1.5 months have been very small sized IPOs, 600 crores, 1000 crores. The real action has happened in May and June in the secondary markets, where you saw almost 28-30,000 crores of blocks going through, getting absorbed without any price damage, and getting absorbed by very high quality institutions, right? So that sort of euphoria is still not there in primary market. Obviously, you will have few very interesting IPOs coming up, but I would rather take a step back and allow them to settle down, because they are listing at 80-90% premium, and we have seen in the past when you tend to rush into to buy a IPO which subscribes 70-80 times, and the listing happens at 80-100% sort of a premium, then your forthcoming compounding for the next 1 or 2 years, it gets jeopardized.
Like how it happened for new age companies, a lot of euphoria. You saw those probably big numbers coming in for all these IPOs. Listing gains were probably a day of euphoria there, and then markets are still looking at the levels from which they actually started from.
Absolutely. So, but just to make another point on that, some of these IPOs are coming in very interesting and niche areas like EMS space, defense.
Right.
These are the companies which are basically the flag bearer of those respective niche spaces, because you don't have too many options in those spaces. So every new company which comes in helps in price discovery and value discovery for that industry, because you then get a benchmark as to how to look at that space. Suddenly you have 4 or 5 EMS companies today to look at, which is not the case a year back. So interest has come back in defense in the last 2 years. In fact, the entire PSU space, we've done a report in November about the revival of PSU after 10 years of stagnation. Basically, the profits had gone nowhere for 10 years, and then in the last 2 years, the profits tripled. Right. Thanks largely to what happened in PSU banks, because PSU banks as a pack themselves did 1.1 or 1.2 lakh crores of profit versus losses that they reported in FY18. So there are going to be a lot of new areas which are going to open up, because we are still talking about an economy which is on the move up from 3.5, 3.6 to $5 trillion. So a lot of new spaces will open up like they have been in the past. 6-7 years back, we didn't have insurance as a sector listed. We didn't have asset management as a sector listed. We didn't have wealth management. So similarly, you will see a lot of new areas opening up and getting listed and getting represented in index also.
Right, those are the data nuggets. Quite literally, we have had a very quality conversation, I would say, and we've also touched base on host of themes that are expected to be in focus, and that probably not do well. But Gautam, thank you so much for taking out the time and speaking to us this morning. It was indeed a pleasure having you with us in the studio. All right, viewers, with this it's a wrap, and goodbye from the entire team who puts this piece together for you. Thank you so much for watching. Please do post your feedback for us in the comment section below and log into moneycontrol.com and the Moneycontrol app for more.